Hello and welcome back to our channel. Today we will be looking at part 2 of blockchain and all of its components. If you missed part 1, please click the link above. We recommend watching it first. Blockchain versus banks. Banks and decentralized blockchains are vastly different. To see how a bank differs from blockchain, let's compare the banking system to Bitcoin's implementation of blockchain. Banking and finance. Perhaps no industry stands to benefit from integrating blockchain into its business operations more than banking. Financial institutions only operate during business hours, 5 days a week. That means if you try to deposit a check on Friday at 6 p.m., you will likely have to wait until Monday morning to see that money hit your account. Even if you do make your deposit during business hours, the transaction can still take 1 to 3 days to verify due to the sheer volume of transactions that banks need to settle. Blockchain, on the other hand, never sleeps. By integrating blockchain into banks, consumers can see their transactions processed in as little as 10 minutes, to basically the time it takes to add a block to the blockchain, regardless of holidays or the time of day or week. With blockchain, banks also have the opportunity to exchange funds between institutions more quickly and securely. In the stock trading business, for example, the settlement and clearing process can take up to 3 days, or longer, if trading internationally, meaning that the money and shares are frozen for that period of time. Given the size of the sums involved, even the few days that the money is in transit can carry significant costs and risks for banks. European bank Santander and its research partners put the potential savings at $15 billion to $20 billion a year. Capgemini, a French consultancy, estimates that consumers could save up to $16 billion in banking and insurance fees each year through blockchain-based applications. Currency. Blockchain forms the bedrock for cryptocurrencies like Bitcoin. The US dollar is controlled by the Federal Reserve. Under this central authority system, a user's data and currency are technically at the whim of their bank or government. If a user's bank is hacked, the client's private information is at risk. If the client's bank collapses or they live in a country with an unstable government, the value of their currency may be at risk. In 2008, some of the banks that ran out of money were bailed out partially using taxpayer money. These are the worries out of which Bitcoin was first conceived and developed. By spreading its operations across a network of computers, blockchain allows Bitcoin and other cryptocurrencies to operate without the need for a central authority. This not only reduces risk but also eliminates many of the processing and transaction fees. It can also give those in countries with unstable currencies or financial infrastructures a more stable currency with more applications and a wider network of individuals and institutions they can do business with, both domestically and internationally. Using cryptocurrency wallets for savings accounts or as a means of payment is especially profound for those who have no state identification. Some countries may be war-torn or have governments that lack any real infrastructure to provide identification. Citizens of such countries may not have access to savings or brokerage accounts and therefore, no way to safely store wealth. Healthcare. Healthcare providers can leverage blockchain to securely store their patients' medical records. When a medical record is generated and signed, it can be written into the blockchain, which provides patients with the proof and confidence that the record cannot be changed. These personal health records could be encoded and stored on the blockchain with a private key, so that they are only accessible by certain individuals, thereby ensuring privacy. Records of property. If you have ever spent time in your local recorder's office, you will know that the process of recording property rights is both burdensome and inefficient. Today, a physical deed must be delivered to a government employee at the local recording office, where it is manually entered into the county's central database and public index. In the case of a property dispute, claims to the property must be reconciled with the public index. This process is not just costly and time-consuming, it is also riddled with human error, where each inaccuracy makes tracking property ownership less efficient. Blockchain has the potential to eliminate the need for scanning documents and tracking down physical files in a local recording office. If property ownership is stored and verified on the blockchain, owners can trust that their deed is accurate and permanently recorded. In war-torn countries or areas that have little to no government or financial infrastructure, and certainly no recorder's office, it can be nearly impossible to prove ownership of a property. If a group of people living in such an area is able to leverage blockchain, transparent and clear timelines of property ownership could be established. Smart contracts. A smart contract is a computer code that can be built into the blockchain to facilitate, verify, or negotiate a contract agreement. Smart contracts operate under a set of conditions that users agree to. When those conditions are met, the terms of the agreement are automatically carried out. Say, for example, A potential tenant would like to lease an apartment using a smart contract. The landlord agrees to give the tenant the door code to the apartment as soon as the tenant pays the security deposit. Both the tenant and the landlord would send their respective portions of the deal to the smart contract, which would hold onto and automatically exchange the door code for the security deposit on the date the lease begins. If the landlord doesn't supply the door code by the lease date, the smart contract refunds the security deposit. This would eliminate the fees and processes typically associated with the use of a notary, third-party mediator, or attorneys. Supply chains. Suppliers can use blockchain to record the origins of materials that they have purchased. This would allow companies to verify the authenticity of their products, along with such common labels as organic, local, and fair trade. As reported by Forbes, the food industry is increasingly adopting the use of blockchain to track the path and safety of food throughout the farm-to-user journey. Voting. As mentioned, blockchain could be used to facilitate a modern voting system. Voting with blockchain carries the potential to eliminate election fraud and boost voter turnout, as was tested in the November 2018 midterm elections in West Virginia. Using blockchain in this way would make votes nearly impossible to tamper with. The blockchain protocol would also maintain transparency in the electoral process, reducing the personnel needed to conduct an election and providing officials with nearly instant results. This would eliminate the need for recounts or any real concern that fraud might threaten the election. Advantages and disadvantages of blockchain. For all of its complexity, blockchain's potential as a decentralized form of record-keeping is almost without limit. From greater user privacy and heightened security to lower processing fees and fewer errors, blockchain technology may very well see applications beyond those outlined above. But there are also some disadvantages. Pros. Improved accuracy by removing human involvement in verification. Cost reductions by eliminating third-party verification. Decentralization makes it harder to tamper with. Transactions are secure, private, and efficient. Transparent technology. Provides a banking alternative and way to secure personal information for citizens of countries with unstable or underdeveloped governments. Cons. Significant technology cost associated with mining Bitcoin. Low transactions per second. History of use and illicit activities. Regulation. What's next for blockchain? First proposed as a research project in 1991, blockchain is comfortably settling into its late 20s. Like most millennials its age, blockchain has seen its fair share of public scrutiny over the last 2 decades, with businesses around the world speculating about what the technology is capable of and where it's headed in the years to come. With many practical applications for the technology already being implemented and explored, blockchain is finally making a name for itself at age 27, in no small part because of Bitcoin and cryptocurrency. As a buzzword on the tongue of every investor in the nation, blockchain stands to make business and government operations more accurate, efficient, secure, and cheap with fewer middlemen. As we prepare to head into the third decade of blockchain, it's no longer a question of if legacy companies will catch on to the technology, it's a question of when. Thank you for watching. If you enjoyed the video, please like and subscribe so not to miss out on more.